Hi Viraj, thank you so much for taking the time out today to talk to me. I'm sure our investors will be very happy with this interview that we are about to embark upon. When we talk about healthcare, and when I think about healthcare, I think about this image of what happened during COVID, especially peak COVID, especially in our capital city of Delhi, where we are short of beds and people are looking for oxygen. That kind of comes to mind, and it's not a very positive image to think about. So really, I wanted to understand from you why healthcare, and why are we thinking about a fund in this
Yeah,
space?
sure. Thanks for having me here. It's a very pertinent point that you brought out at the beginning. So I think why look at healthcare and why look at now? I think healthcare now. I think I will answer those two questions together. Let me try. If we look at it, we are at a very interesting inflection point in India. It's true to some extent globally as well, but first let's focus on India. If you look at our demographics, you would have read the news reports wherein our fertility rate has fallen below the 2.1, which is the replacement rate. So what it effectively means that each couple is having less than 2 children on average. So we are not replacing ourselves. Our population will continue to grow for the next 5, 10, 15 years, but because we'll get older. But it's not that new young people are getting added, it's that the existing people will live longer and the society will age. So the number of people above the age of 40, 50, 60 will increase materially over the next 10, 15, 20 years. So today our median age is 28 years. In 2050, it is expected to go to 38 years. So that's the shift that is happening. And whenever such a shift in median age happens, the demographic shift happens, the spending patterns of households, of governments, of the society in general will shift from kids, education, etc., towards old age care, health care, treatment of certain ailments, diseases, etc. So that's the shift that is happening in India. If we take some global example, say let's take the case of the US. In the 1970s, the median age of the US was 27 years, which is exactly where we are today roughly. In 2015, they went to 37 years. So it was a 10-year shift from 1970 to 2015. A 35-year period, mein their median age went from 27 to 37 years. That was a shift that happened. During that period, healthcare spends as a percentage of GDP in the US went from 9% to 21%. So healthcare spends or healthcare companies' revenues grew far higher than the GDP growth of the country during that period of 35 years. If you look at the share price returns of during that period, the MSCI US Healthcare Index went up some 90x versus the S&P 500 going up 45x. So almost 2x the returns of the MSCI Healthcare Index. So I think that is the kind of delta that can happen because you have a sector wherein structurally the earnings growth or at least the top line growth can be higher than the BSC 500 or the Nifty growth, and that is just on the back of demographics. And some of these demographic factors are not going to shift very dramatically in the foreseeable future. And to come back to your beds wala thing, because that's a very pertinent point over there. As this shifts happens, we are already quite underpenetrated in India. So if we see the number of beds per 1,000 people in India is only 1 or 1.2. The WHO recommended benchmark is 3. And countries like Japan, which are quite old in terms of their demographics, are at 9 or 10 beds per 1,000 people because they need it given their demographic structure as such. So that is the direction we have to go in. Also, the beds that we have aren't of the highest quality as of today. A lot of them are in government hospitals or other primary health centers sort of places, which may not be the most cutting edge or the best in terms of the service that they are providing. So it provides a good leeway for a lot of the private hospitals or the newly listed hospitals that we have. Some of these are expanding quite rapidly because they see that the demand is out there. There's a lot of nascent demand that is out there, which will automatically come once these institutions are set up as such. So that provides a good 10-15 year leeway. You increase penetration. So if you remember back in 2000 where private banks got licenses in India, it was a period where the financial inclusion in India was very low, or the penetration of finance services was very low. Also, bulk of it was through PSU banks. Over the next 15-20 years, some of the newly listed private banks were able to increase penetration and also gain market share from the PSU banks because they brought in tech, they brought in efficiency, among other factors. A similar story can play out in the healthcare space in India as well, wherein you increase penetration for the next 10-15 years and you also gain share from the government hospitals, primary health centers, etc. So I think that's the story, or that's the medium term picture that we see today. And that is why we are quite excited to launch this fund at this point in time.
Understood. Thank you. So, with this fund coming in around 10th of November, and obviously it's a new fund offering, we are looking at a fund that, is it going to be a concentrated portfolio targeting a niche space in the healthcare pharma space, or is it going to be more secular with higher number of stocks?
I think let's separate the number of stocks from the niche that this fund wants to be in. So we do not want to be too concentrated in that we'll have only 10-15 stocks. Idea is to run a balanced portfolio. So if you look at the healthcare space in India, or the listed space in India, it can be split into 4 different themes: hospitals and diagnostics, export generics, domestic branded formulations or medicines, and CDMO. So these are the 4 themes that you can split the entire space in. Our idea is to have 20-30% of the portfolio in each of these themes. We believe that these 4 themes on a standalone basis have good tailwinds for the foreseeable future. Each of these 4 themes are quite distinct from each other. Like what is happening in export generics, where we are exporting to the US, is very different from what is happening in hospitals in India, because there is no correlation between these 2 sectors. Similarly, what is happening in CDMO will be very different from what is happening in branded formulations or branded medicines that are getting sold in India. So these are quite distinct segments. They have their own tailwinds, and the idea is to be 20-30% in each of these segments, and never be too aggressive or too defensive on any segment. We'll never be 0% in hospitals, for example, or we'll never be 50% in generics, for example. Run a balanced portfolio, and within each segment have a very strong bottom-up stock picking process, wherein apart from the traditional filters like ROE valuation, which obviously we'll use, the idea is to use segment-specific filters, because what we'll look in a hospital will be very different than what we'll look at in a export generic sort of a setup. In a hospital, it's a real estate business. You're looking at the micro market, you're looking at the supply demand, you're looking at the brand, you're looking at the kind of doctors the hospital has, you are looking at the kind of therapy or the kind of treatment the hospital offers. In an export generic, it's a completely different ballgame. You're looking at the number of facilities that he has. Are they US FDA approved? Has there been history of inspections where they have got too many observations, or are there regulatory compliance processes in place? So that's a very different way of looking at it. So each of these sectors will have a different reliance. So the idea is to have a very balanced top-down allocation, 20-30% to each segment. But within each segment, we have a very strong stock picking process. Ideally, in my view, anything between 30-40 or 25-40 stocks is a good number. 40 will be very rare when we are finding too many opportunities in the market. Typically, between 25, 30, 35 would be an ideal number of stocks that we own in the fund.
Understood. One particular concern that many investors will be around the tariff space. And it's something that probably no one would have thought of even a year back. And, now we have only one person to thank for that. So to what extent do you think, the mood in the White House is going to impact how you manage the portfolio?
That's a very, very pertinent question again. Many analysts on the sell side especially, and on the buy side, have had many sleepless nights because of that one man that you are referring to. Because decisions get changed every day, it creates a lot of uncertainty even for us. But if you take a step back and look at the broader picture, I think exports there are 2 things which are relevant. One is the generics and one is the CDMO space. So first, let's focus on the generics. So generics is, let's get a bit into technicals. What is a generic? So in generic is a copy of a patented drug. So whenever a new drug is launched in the US, it's patented. there is a patent for 10 years where the innovator company has exclusive license to sell it. Once the patent expires, generic companies, a lot of which are present in India, have the license to make a copy or make a similar drug and sell it. As soon as a generic is launched, the price of the medicine or drug falls 90 to 95%. So a generic drug for the same illness is 90 to 95% cheaper than an innovator or branded drug for the same, and it's the same drug effectively. It's not that the drug is different. So if you look at the data, 80% of the drugs consumed by the US by volume are generics, and only 8% by value. So generics are 80% of the volumes, but 8% of the value. If there are tariffs on generics or any adverse ruling comes on generics, the cost of these medicines is going to go up. India supplies 50% of the generics consumed in the US. So we are a big share. So if they put tariffs on us, 50% of their medicines are going to become very expensive. Now, who pays for this medicine? The customer doesn't pay, but it's the insurance companies and it's the government that pays for these medicines. It's the Medicare, Medicaid programs which pay. These are underfunded. US government has high levels of debt. They have very high fiscal deficit. So in this context, it's difficult to imagine a scenario where they want to pay more for these drugs out of their own free will. Yeah. The other question is, can this supply chain be shifted from India back to the US? That's the other question on everyone's mind for generics. So generic companies in India make very low margins and ROEs. So if you look at a company doing generics only, there are hardly any. The ROEs will not be more than 15%. The way these companies work is they do some generics in the US, they do some exports to Africa, Asia, etc., and they do branded in the US. So combination of these three, they make 20% margin. But their US generics would be sub 15 and India will be 25 plus because it's branded business. The cost of manufacturing drugs in the US is 2.5 times more than India at least. So if there are hardly any margins, costs are high. So it is very difficult to shift this production from India to the US, and those companies are also ROC oriented because US is a capitalistic society. Unlike China, where they are okay with low ROC, the US is not okay with low ROC generally. So it's difficult to see generics either getting tariffed heavily or that supply chain moving from India to the US. So the worries for me are less in that segment. When we come to CDMO, yes, the risks over there are higher. Especially some of the CDMO companies supply to innovators. Let's again take a step back, understand what is CDMO. In CDMO, it's nothing but a custom development manufacturing outsourcing. So a US innovator which is manufacturing or which wants to sell a particular drug in the market will outsource the manufacturing of that drug to some other partner because his primary thing is to do the R&D and to get the drug in the market, to do the branding, to do the sales and distribution, etc. For manufacturing, he'll have manufacturing partners. Some partners might be in the US, some are in Europe, some are in China, some are in India. India's market share in the CDMO space is only 3.5%. So unlike generics, we are not very big in this space. If especially the drugs that are sold to innovators, the innovators have very high gross margin on these products. So if we are selling them to the innovator for 5 rupees, they are selling for 100 rupees in the market. So there is a risk that some of this production can get shifted from China, Europe, India into the US. But again, because our share is so low, the risks to us are lesser. Plus, it opens up interesting opportunities for us as supply chain shifts from China to the US. In the US, they will not be able to do end-to-end manufacturing. They will do the final stage in the US, but they will require the ingredients, they will require the APIs, they will require some other intermediates which are required for the manufacturing process, and that opens the door for us to compete. Not necessarily we'll get all that market over here, but at least we'll be in a position to compete with China, to compete with Europe, and gain some share of this market. So yes, in export generics, I think the risks are minimal, the way I see it. In CDMO, the risks are higher, but they can be managed. That is where the stock picking comes in. If there are CDMO companies which have US manufacturing facilities, then there is not so much of a worry because that is what they want. They want these drugs to be manufactured in the US, so it's easy. If some companies are supplying majority of their products to Europe, again, that is not such a big worry because a lot of the big pharma is based in Europe. So you supply to Europe, from there it goes to the US. And there is a deal between most European countries and US where the tariffs are minimal, those 15% tariffs, which is the country level tariff. So there's some bottom-up stock selection is required, wherein you are avoiding those companies which have a 100% exposure to the US and their factories are based in India. Then the tariffs can really impact some of these companies. Otherwise, I think there are risks, but they can be managed to that extent.
Understood. Thank you so much. One last question before we end. Could you just give a brief summary of your experience and your background so that clients who are watching this understand who they are entrusting their money with? Yes.
So so I've been in the industry for I think more than 12-13 years now. But I've been associated with Bandhan for the last 10 years. I started out in Bandhan as an analyst, tracked various sectors, IT, retail, mid caps, broad mid cap space, chemicals, etc. 3 to 4 years ago, I started managing funds. Currently, I'm managing our flexi-cap fund, multi-asset fund, and retirement fund, and healthcare will be the newest addition to the lot. I'm basically an engineer, and I've also done my MBA back in 2010, 2012, so some time ago as such. So that's about me.
Okay. Thank you so much. Thanks again for taking the time out for this interview.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.